You ever look at your savings and think, I did everything right, so why does it still feel fragile? You saved, you avoided stupid risks, and yet inflation eats into it. Markets swing, and suddenly you're wondering if cash itself is the risk. I've watched people go through that cycle for decades, and the mistake is always the same. They chase certainty in an uncertain system. My name is Frank, and I spend way too much time thinking about relevant financial topics. If you're someone who's trying to protect your money without gambling it away, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Look, I've been around markets long enough to see gold get written off and then quietly bought by central banks. Today, central banks hold over 35,000 metric tons of gold. Countries like the US, Germany, and increasingly China have been adding to reserves, not because it grows fast, but because it anchors trust when currencies don't. That's the government perspective. Gold is not about return, it's about credibility. Now here's where people get emotional. Bitcoin. Bitcoin isn't held the same way by governments, at least not yet. But institutions, different story. Hedge funds, asset managers, even pension exposure is creeping in. At its peak, Bitcoin crossed $1 trillion in market value. That doesn't happen because of hype alone. That's liquidity, derivatives markets, custody infrastructure, a real market structure forming. Here's the thing. Gold trades in a deep, slow, globally coordinated market. London, New York, central bank vaults. It reacts to real interest rates, currency debasement, and geopolitical stress. Bitcoin trades in a 24/7 liquidity-driven market. It reacts to capital flows, risk appetite, and monetary expansion. Two completely different engines. Now you might be thinking, so one replaces the other? No, that's not how markets evolve. Here's what most people don't realize. Gold dominates the $20 trillion store of value market because it's proven. Bitcoin is trying to capture a slice of that market, not by replacing gold, but by appealing to a different generation and a different system. Digital, borderless, independent. Here's where it gets really interesting. Watch what countries are doing, not what they're saying. The US holds gold to back long-term confidence in the dollar. China and Russia have been accumulating gold aggressively to reduce reliance on the dollar system. Meanwhile, smaller economies and younger populations are adopting Bitcoin as a practical hedge against weak currencies. That tells you something. Gold is still the state asset. Bitcoin is emerging as the individual's hedge. Now let's talk about the next 30 years. If debt keeps expanding, and historically it always has, currencies will continue to lose purchasing power over time. Gold will likely remain the foundation layer, slow, stable, and trusted by governments. Bitcoin? If adoption continues, it becomes a high volatility, high upside layer, not replacing gold, but complementing it. Think of it like this. Gold is the bedrock of a financial system. Bitcoin is the new infrastructure being built on top of uncertainty. Now here's the mistake I've seen for 50 years. People don't diversify across time-tested logic. They chase narratives. They go all in on what feels right, instead of what balances risk. A disciplined approach: hold gold for stability and systemic protection. Hold Bitcoin for asymmetric upside and monetary evolution. Size both modestly, because neither is meant to carry your entire financial future. That's not exciting, but it works. Because at the end of the day, wealth isn't built by being right once. It's built by surviving every cycle. So, don't pick sides. Understand the structure. Position accordingly. And if this gave you a clearer perspective, hit that like button, subscribe, and I'll see you in the next one.